These are the things that matter most before Wall Street opens today. The market is trying to price relief, but relief is not the same as confirmation. Oil is lower after the United States and Iran paused fighting over the weekend. Stock futures are firmer. At the same time, investors are walking into a week where tariffs, AI trust, earnings positioning, and the Federal Reserve all compete for attention. The question for private investors is simple. Is this a cleaner risk-on setup or just a temporary release of geopolitical pressure? Start with oil and geopolitics. The pause in fighting gives markets a reason to unwind the immediate energy shock. Lower crude can help airlines, transports, consumer discretionary stocks, and inflation-sensitive parts of the market. It can pressure integrated oil and exploration names if traders decide the risk premium is fading. But the useful signal is not the first move in oil. The useful signal is whether equity leadership broadens beyond a relief bounce. If crude stays lower and yields do not spike, the market can treat the pause as a margin and inflation tailwind. If the situation reverses, the same stocks that benefit from lower oil can quickly become vulnerable again. Winners can include airlines, transports, and rate-sensitive consumer names. Pressure can fall on Exxon, Chevron, and oil service exposure. For private investors, this is a confirmation test. Lower oil helps only if it lasts long enough to change inflation and margin expectations. Second, tariffs are back as a margin story. CNBC reports that the new tariff push is different this time because it targets a wider set of trading partners, including the European Union, China, and the United Kingdom. That matters because tariffs are not just a macro signal. They travel through company margins, supplier contracts, and pricing power. The strongest companies are not the ones with the loudest tariff commentary. They are the ones with cleaner domestic demand, flexible sourcing, and enough brand power to protect margins. The vulnerable group is more specific. Import-heavy retailers, hardware chains, and autos where higher input costs arrive before customers accept higher prices. Winners can include companies with local revenue and pricing power. Pressure can fall on Walmart, Target, and Ford if investors focus on cost pass-through. For private investors, the right filter is not whether tariffs are good or bad. It is where the cost actually lands. Third, the AI story is becoming a trust and infrastructure test, not just a chip demand story. CNBC reports that Nvidia, Microsoft, SpaceX, and others are backing a new AI safety initiative after OpenAI cyberattack fallout. MarketWatch highlights a separate risk. Data center stocks can face voter backlash when electricity bills rise. That is the underappreciated story today. AI can still be a major growth theme, but the bottleneck is shifting from excitement to permission, power grids, cyber trust, local politics, and capital discipline. If the market only watches chip revenue, it may miss the public infrastructure constraint around the trade. Winners can include Nvidia, Microsoft, and power providers that can prove reliable capacity. Pressure can fall on crowded data center utilities, speculative AI infrastructure, and companies exposed to cyber trust concerns. For private investors, the takeaway is clear. AI winners need demand, but they also need permission to build. Fourth, Apple adds an earnings positioning check. CNBC notes unusual Apple options activity into earnings after a strong rebound from late June. That does not mean Apple must move in one direction. It means the market is paying for a larger information event. Apple matters because it can tell investors whether megacap leadership is broadening or narrowing. If Apple confirms stronger device demand, services resilience, or AI credibility, the broader index has more support. If the move fades, it reinforces the idea that megacap rallies need proof, not just positioning. Winners can include Apple, quality megacap platforms, and semiconductor suppliers if the message is strong. Pressure can fall on crowded calls, weak hardware suppliers, and names where expectations already ran ahead. For private investors, this is not a prediction. It is a volatility checkpoint. Here is the stock-led watchlist for today. First, Exxon, Chevron, and United Airlines. This basket asks whether oil relief is real enough to rotate away from energy risk and toward travel or consumer margin relief. Second, Walmart, Target, and Ford. This basket tests whether tariffs are treated as abstract politics or as a company-level cost problem. Third, Nvidia, Microsoft, and Vistra. This basket asks whether AI infrastructure is still a clean growth trade, or whether power, cyber, and politics start to matter more. Fourth, Apple, Broadcom, and QQQ. This basket tests whether megacap earnings positioning supports the index or whether the rally is too concentrated. Market bias, cautiously constructive, but proof-driven. The pre-market setup looks better because oil pressure is easing and futures are firmer. The risk is that investors confuse geopolitical relief with durable earnings confirmation. The mistake to avoid is chasing the first green screen without checking leadership. If lower oil, tariff pass-through, AI infrastructure, and Apple positioning all confirm, the market can broaden. If only one of them works, this remains a selective market. Tomorrow's watch: oil stability, tariff margin commentary, AI infrastructure trust, and Apple earnings positioning. Research context only. This briefing is not investment advice.